All right. So today, our live session is about the market strategy. So central bank pivots, U.S. sentiment trends, and the energy gold nexus. So this is a daily brief regarding the economic indicators that we are going to look for this week, and at the same time, updates on the WTR WEX, Texas Intermediate and Gold. Welcome to ACY Securities. I'm Ira Reyes, Macroeconomic Strategies. Today, we will discuss update from Japan's economic status, US Conference Board Consumer Confidence, weekly outlook for West Texas Intermediate and Gold. Just to note, this is a reminder that this isn't financial advice. This is simply my personal view of how I read the market movements. Trading always involves risk. There are no guarantees, so make sure you manage your risk properly. For my market analysis, I utilize a dual layered approach that synthesizes macro level catalysts with technical precision. By cross referencing fundamental shifts against statistical trends, I execute high conviction trades where market sentiment meets optimized expectancy. So let's begin now. So before we start, let's have an update first on the fundamentals or regarding the geopolitical tension. So earlier today, we received that news that Trump reviews peace plan. So there is a UN calls for Hormuz to reopen. Now, President Donald Trump is reviewing an Iranian peace proposal that seeks to end the current war and reopen the Black Strait of Hormuz. Though the US remains firm on its red lines regarding nuclear weapons. While Iran suggests delaying nuclear talks until the conflict is resolved, the US military continues to enforce a blockade, recently seizing another Iranian flag oil tanker. So, meanwhile, the UN or the United Nations is a warning of a potential global food crisis is if the shipping deadlock persists, as fighting also continues between Israel and Hezbollah despite a previous ceasefire attempt. So, regarding this news, what is the impact on the assets? First, we look on the Brent crude. So the current trend that we are looking at, it could be a bullish. So it might jump to 108 above. And the key driver for this is that continued closure of Strait of Hormuz and the U.S. blockade. For the S&P 500 index, the current trend could be bullish on the records. So resilience in tech earnings or the technology and despite geopolitical tension. For the US dollar, it will be on a bearish trend, diplomatic impasse, and anticipation of the upcoming Fed meeting that is going to be within this week. And for the gold, we expect a neutral or steady trend, balancing safe haven demand against rising interest rate yields. So markets are volatile as U.S. Blockade and the Strait of Hormuz being closed and keeping the oil prices high, fueling inflation fears. So while strong tech earnings offer some support to this, the broader market remains cautious, fearing that high energy costs will force central banks to keep interest rates elevated. So again, for from long-term trend, we will see or view the central banks that they might keep the interest rates high. So looking right now on the economic indicators for today, we have both from medium impact from Japan, that is the unemployment rate, and the Central Bank of Japan, which is the BOJ, that right now they on the 0.75%. And as well from the United States later would be the consumer confidence or the conference board. So looking on this data for the yen, we have the unemployment report. So for this one, the news today, it was released that unemployment rose to 2.7. So the forecast is 2.6, but right now it's higher than expected, which means the bar chart shows unemployment has been incredibly stable, hovering between 2.4 and 2.8% for the past year. Now, what is the impact of this 2.7%? of the unemployment rate. So the reaction, if you're going to look on the candlestick, here on the USD JPY chart, this is the 1 hour chart. So the reaction is that how the yen reacted immediately after the news. Since the unemployment was higher than expected, it typically weakens the yen, sending the USD JPY upward. So in comparison to this, the line graph, this one, the USD JPY and the event, which is the unemployment rate, um, the line graph correlates the unemployment rate, which is the green, and the exchange rate, which is the blue, to see if long-term trends the match. So what is the probability of this? We are looking right now on the chart is that um, the key insight is when the actual rate is over forecast, like what happened today, the USD JPY has a 62.5% probability of rising within the first 60 minutes. Now, higher unemployment in Japan often leads to a weaker yen, and today's data follow that over forecast trend. So, we have technicals for this week. So this one, we have the 159.87 if it's breached, because right now it's on 159.268. So the pair is currently locked in a period of consolidation. So it's carving out on a technical triangle and near historic high. So the resistance is would be on the 159.87, and this one is the critical barrier. So if breaking above this 159.8 to going to 1.60, it could spark a new rally, but it also risks triggering direct intervention or sharp warnings from Japanese officials to protect the yen. So right now it's 159. Earlier it was on above 158 level, but this is the key trend line. Supported the 50 period moving average. As long as prices stay above it, the outlook remains positive. So what is the critical support that we're looking right now? It's on 157. Again, this is for the weekly outlook for the yen. So this is the floor price right now. So dropping below this 157 level would break the upward trend and could lead to a much larger price drop. So for the RSI right now, it's on the 50 midline. So it reflects temporary equilibrium and a neutral short-term trend. So again, 160, this is the upside if the Fed stays aggressive. Looking right now on the peg on the US dollar. So if the Fed stays aggressive on rates and the Bank of Japan, because right now it was already announced that 0.75% is the actual interest rate for Japan. It will remain vague on future hikes, but the downside, if it will go down to 157, a drop, it would need a surprise hawkish stance from the BOJ. So right now it's on 0.75. Now, looking on the impact of the interest rate in Japan, so just to give you outlook on this one. So here, so the Bank of Japan just held steady at 0.75%. So if the yen doesn't find its footing, here we can see this a scenario of a stagflation light narrative. It might just take the wheel. So 0.75 is the current rate, and 60% the historical decline probability, and 160 level or the 160 flat is the key price level for the USD JPY. That is our target, and it's on the 1 hour chart that we're looking at. But let's have an insight first for the yen. So is the 0.75% right now good for the yen? For savers in Japan, it's a good improvement. After years of earning nothing on deposits, of course, 0.75, and the rising yields on the JGBs, it's finally offers some return. Now, for the yen's value, it's a bit of a struggle because 0.75% is still much lower than the, for example, 3.5% of other central banks that they can post. You can get in the United States. Investors often sell yen to buy dollars. So that is the we call as a carry trade. This keeps the yen weak, often testing the 160 flat level against the dollar. So for the economy, on the side of the Bank of Japan, So BOJ wants rates high enough to stop the yen from crashing, but low enough not to hurt Japanese businesses that have relied on cheap debt for 30 years. So in short, it's a strong rate by Japanese standards, but it is a weak rate in terms of global standards. So if the yen is weak, it is a massive boost for exporters. Like for example in Germany, if the euro is weak, it's actually it's not really a boost for them because right now they are in stagflation, but if there's no stagflation, it would be a boost for the manufacturing or the exports in Germany. Same thing in Japan because Japan is an export heavy economy. So the stock market for the Nikkei 225, so a weak yen often pushes the Nikkei 225 higher because the major companies on the index are exporters who benefit from the currency drop or dip. So although a low yen is great for some, it creates a tough balancing act for the government due to two major headaches that we're looking at. First is the higher living costs because Japan relies on other countries for most of its food and fuel. A weak currency makes those basics much more expensive. This hits the average family's wallet directly. Next, we have the double pressure on businesses. So with global oil prices right now swinging due to international tensions, local businesses are getting hit from two sides. They have to pay high prices for energy, and those prices are even higher because the yen doesn't go as far. This can really squeeze the profit margins of smaller shops and companies. Now, let's move forward to the United States. We have the consumer confidence later. So, this is the consumer confidence index from the conference board. So what is the current situation right now? Let's have a view from the United States. So the business score, um, people feel better about the current economy, the status right now. More people rated conditions as good as 21.9%, and fewer rated them as bad, which means 6.3%. So 21 is good and bad is 16.3. So the jobs right now in the United States, the job market stayed about the same, while slightly more people say jobs are plentiful, which is around 27%. There was also a tiny increase in saying those jobs are hard to get, which is around 21. So 21 versus plenty versus the hard to get is 21.5%. What is the 6 months or the mid-year outlook for United States in terms of consumer confidence index? So businesses about 18.2 expect things to get better, though 21.3% still expect a downturn. Why? It's because of the ongoing tension. That's the whole main culprit of it. And the jobs, the outlook for employment is getting gloomier, meaning fewer people expect more jobs to be available, which is around 15.4%, while more people expect fewer jobs really at least 27.9%. In terms of income, expectations for paychecks are mixed. While more people expect a rise around 19.2%, there was also a jump in people who fear their income will drop 13.9. That is we're looking for example in the United States, we're looking on the side of the COLA or cost of living adjustment for the seniors. How would they be able to adapt with the current cost of living and what they receive from their social securities? So those are the metrics that we are looking right now in the United States. Now, this is the United States consumer confidence. So what is the impact? Again, let's have an impact check on the index of the S&P 500. So why is this sensitive to this index, the S&P 500? So the S&P 500 is highly sensitive to this because the index serves as a leading indicator for consumer spending, which is the primary engine of the United States or economy. So when consumers feel secure about their jobs and incomes, they spend more. When they are anxious, they cut back, directly impacting the earnings of the 500 companies listed that make up the index. So since consumer confidence or consumer spending is also gross domestic product driver. So right now we note here, by looking at this charts, we note that right now the stock market is on high alert. Why? Because of rising energy costs and tensions in the Middle East. With this index, the consumer confidence predicted to slide at 91.8 to 89.5. And for that, how do we look right now on the Wall Street? How can we picture the entire indices as well? So Wall Street is anxious to see if people will keep spending despite this what is going on in their country. So essentially, investors are testing the strength of the American shopper to see if they can handle the pressure of inflation, which people now expect to hit 4.7% over the coming year. So right now they are on the 3 level, and would they be able to cope up with 4.7, and how would they be able to at least squeeze themselves with the rising energy costs? That is the case right now. That's why we see from every country there is a stagflation spark across reports. We also note that the initial reaction for this one, it can be quickly reversed by broader market trends because we are looking on the index and it's not on the foreign exchange. So this shows how optimistic and pessimistic American consumers about the economy. So last March 31, the score was 91.8, and which was better than expected, the 88 forecast. So that's a good indication for the economy. But the upcoming release on April 28th, the market is forecasting a drop in 89.2. We expect it because of what happened the beginning of the first week of March. So immediate market reaction for this one is that on the candlestick right now, here we see on a green. So the result, even though the confidence data was good, higher than a forecast, the index dropped sharply shortly after the release before seeing a small bounce at the end of the hour. This suggests other factors like inflation fears might have outweighed the positive sentiment that day. So that's why we have to sometimes look for, in particular when there are corporate earnings being released, we have to wait. We have to pause because we expect sometimes on the minute or 1 to 5 minute charts, we expect more and more trading gaps. So for this one, long-term correlation, so the event of S&P 500 and this index. So the divergence for this is that the S&P has been climbing aggressively, so we see this one also in blue. And while consumer confidence has been relatively flat or volatile, this one is the color green. This shows a decoupling where the stock market is rising even if consumers are not feeling significantly more confident. So what is the probability for this index to happen, or expectation? So in terms of consistency, the data shows that whether the release is under forecast or over forecast, there has been a 75% probability of the market rising within the first hour. So historically, 9 out of 12 times for both scenarios. And for the volatility range, in this 1 hour chart that we're looking at, is roughly 0.23%, meaning the market doesn't usually move more than a quarter of a percent in the immediate hour following this specific report. First is because this one is an index, it's different from the foreign exchange that we're looking at, where there is an immediate reaction. Now, moving forward, let's go to gold. So right now, how do we, as an outlook for the gold, is it a safe haven versus the strong dollar? There is a battle for the gold's next big trend. So for now, we are looking for the XAU USD is an in congestion period. There is a concerned struggle between 47 flat and 47.50. So right now the trend is highly sensitive to headlines regarding the Strait of Hormuz. So in the bearish pressure momentum, progress toward reopening the Strait of Hormuz is weighing on gold, as a resolution would stabilize global energy flows and reduce the need for defensive assets. Now, for the bullish support for the gold is that Gold remains supported by the lack of diplomatic progress, which is currently happening right now. And the breakdown of weekend talks, like what happened in the previous weeks, the absence of US negotiators ensure that the geopolitical fear factor continues to prop up prices near the 47 flat. So, what are the fundamental drivers that we are looking at for this gold? So first, let's have an outlook for the dollar index right now. It's between the 98 right now. The market volatility is being suppressed by three major events that will dictate the US dollar direction. So again, if the dollar is higher, it will be very expensive as well for the gold. So the demand of gold might decrease. Now, the Federal Reserve with high interest rates is the main headwind. So if the Fed or the Federal Reserve remains hawkish, gold may test the 660 zone. So trading volume is staying as the market awaits this week Federal Reserve results. So given the recent spike in energy inflation, the Fed is widely expected to maintain its hawkish posture, reinforcing the US dollar strength and suppressing gold's recovery until the FOMC or the Federal Open Market Committee's policy statement and Chairman Powell's commentary are released. Gold is expected to remain trapped in its current neutral zone. So here, what are the factors that could affect the gold? We have first the European Central Bank with their policy shifts affecting the euro dollar balance, which directly impact gold's price. We also have the US GDP or the gross domestic product of the United States. With stronger growth figures could strengthen the dollar, potentially capping gold's recovery. And now for our outlook for this one, the gold is coiling for a breakout. So the current lateral movement recommends if the market is pricing in the Strait of Hormuz deadline and awaiting the Federal Reserve's verdict. So if the 47, so looking right now on the report for the gold, so if the 47 flat, because this one is the support that we are looking right now and currently it's in the 46.93. So if 47 is directly collapsing, the next principal aim is the 100-day moving average of 46.70. So if resistance breaks, a move toward 48.64 is likely the next step. So while technical analysis focuses on price levels and chart patterns, macroeconomic perspective in this report identifies the fundamental drivers behind the movement through three pillars. And these are just one that I've mentioned. So we have the central bank policy, the Federal Reserve and European Central Bank control the value of money. Their decisions on interest rates directly dictate whether the US dollar strengthens or weakens against gold. And the national GDP figures, it provides a health check on the economy, where strong growth often boosts the dollar and caps gold's potential gains. And we also look at the global stability, this one right now on the Strait of Hormuz. So political risks, right, like this, such as the deadline that we're looking at, it represents broad external risk that triggers safe haven buying regardless of what the technical indicators show. So all in all, we are just looking at this one that the gold is very sensitive right now with the headlines because it's being squeezed with the central bank at the same time on the headline. So basically, gold is in consolidation. So until Wednesday, how do we look on the gold? So again, until Wednesday, because that's the FOMC, don't expect gold prices to move much. Investors are staying quiet until they hear from the Federal Reserve. And if the Fed is very relaxed on their outcome, if they say they are not worried about high energy prices, that is only if they're very very neutral when it comes to energy prices and might lower interest rates soon, gold prices will likely go up. If the Fed is really tough on this situation, if they say interest rates need to stay high for a long time just to fight the inflation, gold will likely just keep drifting sideways without much growth. In short, no big news means no big move. Good news about interest rate makes the gold goes up. Bad news about interest rates, it makes the gold stays flat. Now, gold right now is in neutral for now. The standoff will end once we get a definite sign from either from the Fed or global political events. That's our case right now. So we have to watch again to just to show the gold. This 47 flat and 4,750 levels, they are closely the first one to break will decide where is the next direction or the major trend. So next we have the OPEC news. Okay, to give a summary on this is that the war with Iran has neutralized, according to OPEC's influenced by trapping Middle Eastern supplies behind the Strait of Hormuz, so forcing the US to step in the world's most primary energy stabilizer by reaching record export levels and strategically releasing strategic reserves. So Washington has effectively seized the swing producer crown once held by Saudi Arabia. That it means it already tops up the Saudi Arabia by the United States. While US power is limited by market economics rather than cartel style mandates, its ability to selectively ease sanctions and flood the market has granted it unmatched leverage over global energy prices. So, by looking at this one, how are we going to view right now, for example, the index for the WTI? Let me show you right now. So yesterday, as I've mentioned, the impact of the IEA report. This one was released last Friday. So again, what is the impact of that second quarter energy report? This is an example of energy economics. So this is the primary lens. It examines how the supply and demand of energy resources like the oil and gas impact global markets and industrial production. So by now, if we are really relying heavily on this energy, we can already view the industrial production index over the next coming quarters. So the closure of Strait of Hormuz has caused global gas production to crash, meaning sending energy prices to their highest levels in years. While the United States and other regions are trying to export more to help, the damage to Qatari facilities is so severe that it will likely take to at least 2 years for the global market to recover. Although a recent ceasefire has helped lower prices for now, this crisis proves that the world needs more stable energy resources and better international teamwork to prevent future shortages. So for this one, um, talking about the supply is crashing. So global supply has dropped to 8 million barrels per day since February, late February, because that was the time frame that we have before we announce updates on the OPEC update reports. And even though countries like the United States and Canada, they are pumping more, it is not enough to cover the 20 million barrels normally shipped through the now blocked Strait of Hormuz. Now, we also have the demand is vanishing. Why? Because prices are so high. People and businesses are cutting back. This could be a situation wherein we're looking for the good substitutes. So the IEA expect oil demand to shrink by 2.3 million barrels in April, the biggest drop since 2020 pandemic. So the gas to oil pivot, since 20% of the world's LNG or natural gas is also stuck behind the blockade, power plants in Asia and Europe are burning oil instead of gas to keep the lights on. So this extra need for oil is keeping prices from falling too far, even though the economy is slowing down. So for this one, what is our weekly outlook for this one. So this week, a tug of war for oil prices. So let me show my screen for for this one. So this is the WTI right now. So trade the markets right now are trying to figure out which is stronger. In fact, there is not enough oil. It means supply shock, and for the fact that people can afford to buy it, which is the demand destruction that we're looking at. So what are the main drivers for this one? The Federal Reserve, and the Fed is trying to fight war inflation. So high prices caused by the conflict. If the Fed keeps interest rate high to stop inflation, it will make the US dollar stronger, which usually forces oil prices down. Now, we have also expensive gas as a main driver. So with gas at 4.30 per gallon, people are spending less. If upcoming economic reports show that economy is slowing down while prices stay high, or we call it stagflation, oil prices could crash because traders will expect a recession. In short, if the Fed acts tough on inflation and the economy looks weak, oil prices will likely fall as well. Now, the forecast prices are likely to stall or fall. Right now, the market is stuck. It is stuck between good news and bad news, but it is leaning toward lower prices as much as possible. Why prices would fall in bearish? If the Fed keeps interest rates high and peace talks move forward, oil prices could drop towards $79. And why prices would rise? That is the bullish scenario. If the Fed decides to lower rates or sounds less aggressive and the blockade in the Strait of Hormuz continues, prices could jump back to $94.85. Why is there a big price gap? You might notice that the Brent, the global oil price, is much more expensive than the WTI, US oil. This is happening because first, the United States has plenty of oil in storage, which keeps the WTI, or the West Texas Intermediate, prices lower. Second, Europe and Asia are desperate for oil because Middle Eastern supplies are blocked, which keeps Brent prices much higher. So for this one, my right now we are looking at the 87.36 as a price reset button. My first support would be 85.29. This is where the average is currently finding its footing. So it's the pivot zone where the 50-day average movement meets the lowest prices we've seen over the last few days. This is the technical outlook we are for the week. And if it goes beyond, that is the 79.87, if the price below this one or a break, it means the extra cost added by the recent conflict, which is the war premium that we always discuss, has completely evaporated and prices could tumble much further. For the resistance, it's 94.85. Why we are looking at this level before 96? This is the toughest barrier for this WTI. It marks there is a Fibonacci that we are looking at right now. It's near the 50%. So where the 20-day average price is currently trending downward. And the highest would be 96.81 for the WTI. So for this one, looking at this week, how we see the movement of markets, we have to be very cautious. We have to wait for the news before we go to the hour entry price. And on the peak would be between Wednesday to Thursday because of the economic indicators, both from the United States and other countries. So this is our today's outlook. So if you have um, more further details, you can go to our Discord. Here, follow our Discord. We also have a description on the box here on YouTube. And also, you can also follow us here with our market analysis report. We have the price action from Mr. Rafi Grant Capascio and mine from mostly on fundamental analysis. So just go to acy.com and go to news analysis and go to market analysis report. We also have education wherein you can look at how we trade through our own positions and technicals. So that's it. This is our outlook. Have no fear. Ira is here. All is well. Thank you and see you